One Up on Wall Street Book Summary. One Up on Wall Street by Peter Lynch is one of the best books to read for anyone who is looking to pick out individual stocks and start investing and making gains in the stock market. Wall Street has us believing that the people who work there are some kind of gods of finance, and that us mere mortals can never compete with their results and know-how, and that the stock market is far too complex for the general public to understand. One Up on Wall Street by Peter Lynch aims to answer the question, can a normal retail investor like you or me actually make the returns the so-called professionals on Wall Street can make in the same markets? Is it possible that arming a non-finance professional with all the information they need to succeed could actually give them an advantage over Wall Street? In the book One Up on Wall Street by the infamous investor Peter Lynch, he talks about how his simplistic approach to investing has put him on the path to him becoming one of the most successful investors of all time. Before we get into it, please hit that subscribe button and comment, "I subscribed," below, so I know who is serious about increasing their financial well-being. Thanks. There are thousands of stocks which are traded in various financial markets every day. Many of these stocks will not do very well, but on the other hand, there are a number of stocks which will go on to make significant gains for investors year after year. With every stock you invest your hard-earned money into, there is a chance that this stock could become the next unicorn, or as Peter Lynch calls them, multi-baggers. He refers to multi-baggers as stocks which have the potential to double, quadruple, or even 10x your initial investment. This is the elusive 10-bagger. We are going to reveal how Peter Lynch goes about looking for these kinds of stocks and summarize the key points from the book One Up on Wall Street. A great quote from Peter Lynch goes as follows: "The trick is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks, as the fundamental story of the company hasn't changed." There are a number of ways we can start to look for these unicorn stocks, or 10-baggers. The book offers advice on the 6 categories of stocks you should be aware of, and know which one is best for you. You as an investor will have a certain type of category you fall into, which includes traits like tolerance to risk and your budget. But according to the book, Peter Lynch also categorizes types of stock into 6 different types, which are as follows. 1. Sluggards, or slow growers. The sluggards of the financial world are companies which have been around a long time. They were once fast growers, but have fallen back for several reasons. 2. Stalwarts, or medium growers. These are companies which are expected to deliver gains of 30 to 50% with an annual earnings growth of 10 to 12%. Peter likes to keep some of these in his portfolio because they offer protection during market slumps. Peter quotes, "You know you won't go bankrupt, and soon enough they will be reassessed and their value will be restored." 3. Fast growers. Fast growers are the favorites of Peter Lynch. They are small, aggressive new enterprises that grow 20 to 25% a year. This is the category to explore if you want to find the 10 to 40-bagger stocks. According to Lynch, fast-growing companies may be part of a fast-growing industry, but he prefers fast growers in slow-growth industry. The winning stocks in this category were retailers who learned to succeed in one place, then replicated their formula to different locations. Companies such as Walmart, Taco Bell, and Yum Brands. 4. Cyclicals. A cyclical is a company which has sales and profits which rise and fall in regular, if not completely predictable fashion. In contrast to fast growers, cyclical industries expand and contract almost continually. Some examples include the auto, airline, and steel industries. Cyclical stocks do well as economies come out of recession and begin to expand. 5. Turnarounds. These aren't slow growers, these are no-growers. Lynch said turnaround companies are battered, depressed, and often can barely drag themselves into Chapter 11. If they survive and fix their problems, however, they can rebound very quickly, and stock prices are least related to the overall market. 6. Asset plays. This could be any company that's sitting on something valuable that you know about, but that the Wall Street crowd has overlooked. Lynch said these are situations in which a local edge provides the greatest advantage. One example was the Pebble Beach golf course, once public but bought out for $72 million. A day after buying it, the new owner sold a gravel pit on the same property for $30 million. There were and are many hidden and not so hidden assets in many companies and industries. Investors should start by looking for cash on the books. If you are still watching this video, congratulations. You're one of the few who dedicates the time to become financially free. If you want to learn more about becoming financially free, then please hit the like button and subscribe. It really helps me to bring you more great content. Thank you. Don't forget that companies can move around in between these categories too, as well as being able to occupy more than one category at a time. For example, fast growers can often run out of steam and become stalwarts or sluggards. Peter Lynch comments at the end of the chapters about stock categories by saying, "Putting stocks in categories is the first step in developing the story. Now at least you know what kind of story it's supposed to be. The next step is filling in the details that will help you guess how the story is going to turn out." Earlier we mentioned the infamous 10-bagger stock. This is an expression which Peter Lynch uses to describe a stock which has the potential to, or has already, increased its stock price by 10 times. If you can get your hands on a few of these over your investing lifetime, you will have a pretty good investment portfolio. Peter goes on to advise that you need to treat different types of stock differently, and gives us a list of positive signs to look for when investing in a stock and trying to find a 10-bagger. 1. The company name is dull, or even better, it's ridiculous. The perfect stock would be attached to the perfect company, and the perfect company has to be engaged in a perfectly simple business. And the perfectly simple business ought to have a perfectly boring name. The more boring it is, the better. 2. The company does something dull. I get even more excited when a company with a boring name also does something boring. A company that does boring things is almost as good as a company that has a boring name, and both together is terrific. Both together is guaranteed to keep the oxymorons away until finally good news compels them to buy in, thus sending the stock price even higher. 3. The company does something disagreeable. Better than boring alone is a stock that's boring and disgusting at the same time. Something that makes people shrug, retch, or turn away in disgust is ideal. 4. The company is a spin-off. Spin-offs of divisions or parts of companies into separate freestanding entities, such as Safety-Kleen out of Chicago Rawhide, or Toys R Us out of interstate department stores, often result in astoundingly lucrative investments. Spin-offs normally have strong balance sheets and are well prepared to succeed as independent entities. And once these companies are granted their independence, the new management, free to run its own show, can cut costs and take creative measures that improve the near-term and long-term companies. 5. Institutions don't own it, and it's not followed by many analysts. If you find a stock with little or no institutional ownership, you find a potential winner. Find a company that no analyst has ever visited or that no analyst would admit knowing about, and you have got a double winner. 6. Something is depressing about the company. The mortuary business is a good example of this. If there's anything Wall Street would rather ignore besides toxic waste, it's mortality. 7. The company's industry isn't growing. In a no-growth industry, especially one that's boring and upsets people, there's no problem with competition. You don't have to protect your flanks from potential rivals because nobody else is going to be interested. That gives you the leeway to continue to grow, to gain market share. 8. The company has got a niche. I always look for niches. The perfect company would have to have one. Drug companies and chemical companies have niches, products that no one else is allowed to make. 9. It has recurring revenue streams or people have to keep buying it. I'd rather invest in a company that makes drugs, soft drinks, razor blades, or cigarettes than in a company that makes toys. In the toy industry, somebody can make a wonderful doll that every child has to have, but every child gets only one each. 10. The company is a user of technology. Instead of investing in a company that makes automatic scanners, why not invest in the supermarkets that install the scanners? If a scanner helps a supermarket company cut costs just 3%, that alone might double the company's earnings. 11. Insiders are buying into it. There's no better tip-off to the probable success of a stock than that the people in the company are putting their own money into it. 12. The company is buying back shares. Buying back shares is the simplest and best way a company can reward its investors. If a company has faith in its own future, then why shouldn't it invest in itself, just as the shareholders do? Of course, as with anything, there are also traits in a company's stock you want to avoid, and here are the 5 traits of a reverse 10-bagger. 1. The company is in a hot industry. If you had to live off the profits from investing in the hottest stock in each successive hot industry, soon you'd be on welfare. 2. The product is the next best thing. Another stock I'd avoid is a stock in a company that's been touted as the next IBM, the next McDonald's, the next Intel, or the next Disney, etc. In my experience, the next of something almost never is. 3. The company is diversifying. Value for shareholders is lost when the company overpays for acquisitions, and when the acquisitions are completely beyond their realm of understanding. In most cases, buying back shares or raising dividends is a better option than acquisitions. The trick is to find the right acquisitions and related businesses and manage them successfully. 4. It's dependent on a single customer. The company that sells 25 to 50% of its wares to a single customer is in a precarious situation. If the loss of one customer would be catastrophic to a supplier, I'd be wary of investing in the supplier. 5. The company is a whisper stock. From time to time, people will tell you about a company that they think is a great investment opportunity. Most likely, they have been telling about this company to every other person. Those are whisper stocks with a hypnotic effect and a psychological appeal. Those are the key points from One Up on Wall Street by Peter Lynch. There was a lot to digest in this, I know, so feel free to use this video as a reference next time you're looking at what stock to buy. Have a look at this next video to keep on building your financial knowledge. Be sure to subscribe, and please share this video with a friend who is interested in the financial markets and wants to learn more about securing their financial future. I'll see you in the next one. Thanks for watching.